There are some funds that are open-ended fund, and they invest in the Portuguese stock exchange. We are noticing that we are losing a lot of clients that instead of investing with us, they invest in these funds because they value very much the liquidity of these funds, meaning they invest and they can exit whenever they want. But the problem is of these funds is that they are investing in a very small market, that is the Portuguese stock exchange is made just by 20 stocks, and it's not very liquid. So yes, you can exit whenever you want, but the probability of losing money investing in that market is very high. And I would like to explain this very clearly to the investor, because it seems to me that nobody is speaking about it. And the clients are just not aware of the risk they are putting on their portfolio investing in this kind of funds. I'm saying that there are liquid funds that are open-ended, meaning that you can enter and exit whenever you want. But in order to be eligible for the Golden Visa, they need to invest at least 60% of the assets in Portuguese companies. This means that they are very exposed to the Portuguese stock exchange. If you look at the performance of the Portuguese stock exchange in the last 10 years, it has been losing money. So in the last 10 years, it lost value. In very recent years, the last 2 or 3 years, it has been performing very well, but it has been basically driven by 2 or 3 stocks maximum, because Galp discovered a big oil reserve in Namibia, and that drove the stock up more than 30%, and this factor alone made the PSI 20, that is the Portuguese index, grow. So this gives you an idea of how concentrated this market is and how exposed is to the destiny of one of the companies that compose the index. If something bad happens to one of the big companies, the index is going to go down. And it doesn't make sense for someone that says that he values liquidity to be exposed to such concentrated index. This liquidity advantage is just an impression. It's not real, because you are very exposed to a very small and not very liquid market. And besides that, there are some other funds that propose buyback options. This is an alternative to an open-ended fund, meaning that if you want to exit, there is going to be someone that buys you back the shares, basically someone that sign a contract with you, and whenever you want to sell, you have a put option and you say, buy my shares because I want to exit this fund. But this is even worse, in my opinion, in terms of risk. This option will have a counterparty risk, meaning the guy that is going to buy your shares, is he going to be able to pay really the shares when you want to sell? Imagine that a fund raises 100 million and all the clients, for some reason, all of a sudden, they decided they want to exit. The counterparty will need to pay back at least 100 million to the clients that want to exit. If he doesn't have the money, will not be able to pay back. So you have a very big counterparty risk. Doesn't seem to me that they understand this risk. Unless your counterparty is some large bank, large institution, you are exposed to the risk that the counterparty that you signed the agreement for the buyback is not going to be able to pay the shares whenever you want to exit.